Bill Gates once said that if you are born poor, it's not your fault, but if you die poor, it's your fault. These are profound words that say that your birth circumstances does not define your destiny. It's your action, attitude and choices that will define your destiny. So whether you will be rich in the future or remain middle class depends upon the decision you make when you start earning money in your 20s and 30s. The problem is that during the early years of your financial journey, you don't have enough maturity and experience to use your money wisely. You're mostly influenced with what is said on YouTube videos, TV channels and Instagram reels. Above all, your financial decisions are directly influenced by people around you. If your colleagues and friends are buying those fancy cars, spending money on fancy gadgets, exotic vacations, there's a high probability that you will also end up spending money crazily. While there's nothing wrong with spending money on car, gadgets and vacation, the only problem is spending over and above your means. Majority of people end up spending much more than what they can afford just to show off a fancy lifestyle in front of everyone. But the fact is that majority of people who show off fancy lifestyle are actually financially broken. They are under huge burden of debt and they can't come out of it. Because today you can buy anything on EMI, credit card and personal loan. Banks are more than happy to give you that credit card or personal loan as they would earn a high interest on that. Now as far as investments are concerned, today every person wants to become a millionaire overnight. No wonder some of the most commonly searched topics on internet are how to get rich quickly, how to earn money online, multi-bagger stocks to invest money. Today, the internet is full of videos suggesting how you can become rich quickly. But the fact is that nobody becomes rich overnight. It takes years of hard work to achieve success, be it any field. And you ask any successful person how to become rich, and one suggestion would be there is no shortcut for success. You have to work hard towards achieving your goals. Likewise, when it comes to investing, don't look for shortcut. It's very easy to get trapped in the world of trading, crypto, online betting, but the fact is majority of people end up losing money with shortcuts rather than making money. So in this video, I want to share 7 most important pieces of financial advice that can help you avoid most common financial mistake and achieve all your financial goals. Alright, let's get started. So my first financial advice would be focus on earning more rather than just saving. If you search over the internet, the most common financial advice you get is save, save, save. Save every bit of money you make. There's also a saying that every penny saved is a penny earned. Honestly speaking, I disagree with this saving every bit mentality. Let me share my personal experience. When I started earning, I was very clear that I don't want to work forever. The goal was to achieve financial freedom as early as possible. To achieve this goal, I started saving every bit of money. But what I didn't realize is I was compromising on my quality of life. I always used to think that save not to enjoy later. But after a few years, I realized that it's not about the destination. It's about enjoying the journey. So the most important lesson was not to compromise on my present to enjoy in the future. Go out, travel, enjoy with friends. Yes, savings are important, but not at the cost of saving every penny and compromising on the quality of life. In fact, my biggest learning was to focus more on increasing the income rather than saving more and more. Focus on upgrading the skills and earn more. Save money but also enjoy life. This change in mindset from saving every penny to improving my skill and focusing on earning more has made a huge difference in my quality of life without disturbing my financial goals. So my advice would be go and enjoy your life. Buy that iPhone that you always dreamt of, or spend money on vacation. Go out with friends, because if you only focus on saving, when you get old, all you would be left with is money and no energy to spend it, no friends to enjoy with. However, it should not be at the cost of destroying your financial life. You must know your limits. It does not make sense to buy an iPhone worth rupees 1 lakh when your monthly salary is just 30,000. But if you earn a decent salary of say 1 lakh, 2 lakh rupee a month, then you can definitely go ahead and buy that iPhone. So at the end of the day, it's all about making a fine balance. The bottom line is to focus more on earning by upgrading your skills during your early years of financial journey, so that you don't have to compromise with quality of life. My second financial advice would be to avoid getting trapped into the debt cycle. If you have a personal loan or sitting on a huge credit card bill with payment of minimum amount due, you need to get rid of both these loans. The reason is interest on personal loans and credit cards are very high. Personal loans start with 11 to 12% interest and goes as high as 20 to 30% interest per year. Likewise, interest on credit card is in the range of 2.5 to 3.5% per month. That's crazy. Due to such high interest rates, you end up paying much more than what you have borrowed. And it gets very difficult to come out of this debt trap due to lifestyle inflation. Because if you develop a habit of spending over and above your means, you will never be able to save. And even if your earning increase in future, you would keep on upgrading your lifestyle and always run out of money. Although when it comes to credit card, they are not always bad. If you can control your spending and can make regular payment of your credit card bills, it can actually help you build a good credit score. And this good credit score help in negotiating a better interest rate when you have to take out a loan for some of your biggest financial goals like buying a house and a car. But in case of buying a house or a car, you need to be sensible enough to plan your investment well in advance so that you can build a good financial corpus for a significant down payment. It does not make sense to buy a car or house on a 80 to 90% loan. At the same time, you don't need to wait till your 50s or 60s. Again, balance is important. Invest for a few years to make a good corpus for the down payment of say 40 to 50% of your car and house amount. And of course, you have to understand your financial limit before deciding how much you want to spend on the car and house. If you want a Porsche, make sure that you earn enough to afford it, not to show off and get trapped in a massive loan cycle. In short, make sure that you avoid getting trapped in high interest loans like personal loan, credit card bills at an early stage of your career. Otherwise, you will struggle to save and invest your money, and that will be a financial disaster. Rather, invest that money to build a solid financial corpus for your bigger financial goals like buying a house, car, and retirement plan. Then my third advice would be to buy a term insurance. I always say that even before you start your financial journey, you need to take a term plan as a part of risk management. A term plan is a must, especially when you have dependent parents or wife and children, because you want to ensure that in case anything happens to you, your dependent parents and wife can live a dignified life, your children can get the best education, your family does not have to compromise on any financial requirement. While nothing can replace your presence, at least you can ensure that with a term plan, your family will not have to depend upon anyone for financial help. Now, you might not have dependent parents and might not be married yet, but eventually we all get settled in life and have a family. So if you take a term plan at an early age, you get the benefit of high life cover at a very low premium. So for instance, you can get a 1 crore term cover at just rupees 10 to 15,000 per year. If you opt for a term plan during the latest stage of your life, you will have to shell out more money out of your pocket. Now obviously there are hundreds of term plan out there and it gets very difficult to select the right term plan. That's where I would highly recommend setting up a free 30-minute call with Ditto advisors. Now you might ask, why Ditto Insurance? Because in my opinion, it is one insurance platform where you can get the most honest advice without any spam call or message. A direct proof of their work is Ditto has 4.9 star rating on Google out of around 10,000 ratings. Ditto team also help you break those complex insurance jargons in layman language like what is claim settlement ratio and so on, so that you can clearly understand what is good in the term plan and what is not so good, and then select the right term plan after proper understanding. Not only that, the team also help in claim settlement. So you can visit their website, click on book a free call, select a date and time slot and click on confirm. Just enter your few details and click on confirm booking. Then my fourth financial advice would be to buy a health plan. So I was going through some statistics and was surprised to know that 50% of healthcare expenditure in India is still done out of pocket. And considering the rising cost of medical expenses, even a few days of hospitalization can cost a few lakh. So health insurance is also the first thing you should take when you start earning along with the term plan. Friends, it takes just one accident or health problem to potentially wipe out all your savings and investment. Especially with the corporate pressure and unhealthy lifestyle, young folks in their 20s and 30s are already facing many health issues like hypertension, heart problem, blood pressure and so on. Now some people think that they don't have any health issue, so they don't need to take a health plan at an early age. But the best time to buy a health plan is when you are young and healthy, so that you can have a good health cover at a very low annual premium. Otherwise, once you get health issues, you will end up paying a very high premium. And in some critical cases, health insurance firms can even reject your health policy application. So don't wait for the right time to buy a health plan. The right time is today when you are young and healthy. Again, it gets very complicated to opt for the right health policy as there are various terms and conditions that are difficult for a layman to understand. That's where you can take help from Ditto team and set up a free 30-minute call. For instance, there's a catch of co-payment clause where you have to pay a certain percentage of medical expense out of your own pocket. Likewise, there's something called restoration benefit. So make sure that you have a proper understanding before opting for health plan, and Ditto team can help you with that. Then my fifth advice would be to set up an emergency fund. Emergency fund help you plan for the rainy days. It could be a job loss, sudden need for money due to some emergency, or could be COVID-like situation. In such cases, not having an emergency fund can create a lot of financial stress. So it's very important to have 6 to 9 months of your monthly expenses parked in highly liquid instrument where you can access the money immediately. And that should also provide a decent inflation beating return. But remember, don't keep this money in the stock market because you don't want high volatility with your emergency fund. And don't touch this money until there is really an emergency. My sixth financial advice would be plan your financial goals and early retirement. One of the biggest reasons to plan your financial goal in early retirement is to unleash the magic of compounding. So let's say you're a 25-year-old and want to retire at an age of 50. Now if you set up an SIP of 25,000 in equity market, by the time you turn 50, you will end up with a corpus of 6.2 crore. Here we have assumed a 13.5% CAGR rate. However, if you delay this decision and start with the same SIP of 25,000 at the age of 30, by the time you turn 50, you will end up with a corpus of 3.06 crore. So just 5 years of gap can create a massive difference in your retirement corpus. Hence, the earlier you start your investment journey, the more time you will have for your wealth to compound. Then another major benefit of planning your financial goals at an early age is that you always have a good financial cushion to take risk in life. For instance, one of the biggest reasons I was able to quit my job was because I had a good financial cushion due to my saving and investment habit from day one. So back of the mind, I knew that even if I fail in my entrepreneurial journey, I would have enough corpus to sustain my lifestyle for a good few years. If I was also stuck into the EMI cycle, I would have never been able to quit my job. And my seventh financial advice would be to focus on asset allocation. Focusing on asset allocation is one of the most critical aspects of successful investing and long-term wealth creation. So asset allocation refers to the strategy of dividing your investment portfolio among different asset classes such as stocks, bond, real estate, gold, cash to balance risk and reward based on your financial goals, risk tolerance and time horizon. It's important to understand that different asset classes perform differently under varying market conditions. For instance, after COVID, we have witnessed a significant rally in Indian stock market. Now, equity is certainly one of the best asset class to create wealth. But the question is, how much allocation should you keep in stocks and equity mutual fund? 100%, 90%, 80%, 70%, how much? And that decision depends upon the market valuation and earning growth. So during COVID, Indian stock market valuations were ultra cheap. And when the economy opened up and earnings expanded, it resulted in exponential wealth creation for the next few years. But today, after a significant rally, valuations are not very comfortable. That's where you may also want to sit on some cash or want to allocate some money in, let's say, gold as well as debt mutual fund or bond rather than having 100% exposure in equity. Although the exact allocation would depend upon your individual risk appetite and financial goal. Likewise, within equity, you should diversify your money across large, mid and small cap segment as well as across sectors. So this asset allocation strategy helps in balancing your risk and return. So in this video, we discussed 7 financial decisions you must take during your early 20s and 30s to live a financially comfortable life. If I summarize, it includes focus on earning more rather than just saving, avoid getting trapped into the debt cycle, buy a term insurance, buy health insurance, set up an emergency fund, then plan your financial goal and early retirement, and last is focus on asset allocation. And if you need help in selecting the right term plan and health plan, you can set up a free 30-minute call with Ditto team. I provided the link in the pinned comment. Now tell me in the comments, out of these 7 financial advice, which one do you implement in your life? If you find this video useful, do share with your friends. I'll see you next video. Till then, take care.